the variable cost, and S is sales. Another formula is also there, that is PV ratio is equal to fixed cost plus profit divided by sales. PV ratio is equal to fixed cost plus profit divided by sales. That is another formula which can be also find out a PV ratio. One more point, in addition to that, it is possible to compute the ratio by comparing the change in contribution with the change in sales. So sometimes they may be given a 2 years informations for a contribution as well as sales, and then they ask the what amount of reflections in your PV ratio. So in that regard, you need to find out and apply the formula, that is PV ratio is equal to change in contribution divided by change in sales. So that is all about a PV ratio is concerned. Now moving here to the next point, that is MOS, margin of safety. Margin of safety is all means that is the difference between the total sales and the sales at break-even point. So ultimately it is a comparison of what actual total sales is incurred and what you are assumed where you are going to reach at break-even point, that there is no profit or no loss situation. So the difference between these two sales, it is margin of safety. It is known as the amount of the sales above the break-even sales. That means the amount of the position where the break-even sales is lower than this margin of safety situation. Margin of safety can be expressed in absolute terms and also in terms of percentage. So that means you can determine the value of margin of safety in two forms. One is in the form of percentage, and in the other form you might be getting an answer in the format of the absolute term, that means the values. Higher the margin of safety, the better the situation of an organization. That means the margin of safety is higher, it means the organization is so strong and so powerful. A high margin of safety provides the strength and stability of a company. Here, to increase the margin of safety, the company should endeavor to keep its break-even point its lowest level and should try to maintain actual sales at a higher level. So here that they have to think two important role, and they have to think very carefully for two major important part. That one, that the break-even point sales should be lowest. That means for that they need to identify their cost structure is also little lower, but simultaneously they have to try to reach higher level of their actual sales or the net sales. This may be possible either by controlling a cost or by restoring a dynamic sales policy for reducing a certain amount of variable cost. In short, the margin of safety is a difference between the sales and the break-even point sales. In that case, the margin of safety you can find out in rupees as well as in units. Moving to the next part, that is key factor or a limiting factor. I just want to tell you the key factor is actually raised because of limitation and the scarcity of a particular item or a particular factor, like material, like employees, or in case of wages, that is production concern, overheads, or sales, or any other part where the key factor is actually playing a major role. There are always factors which for the purpose of managerial control that do not lend themselves. That means if you are going to limit them, then it might be creating a difficulty for us. For an example, there are legal restrictions that on the import of a material for some specific time and some specific type of material, then the chief element of the company for a product that the company cannot carry out without that material from the different sources, the production has not been continued, that would be stopped. So production has to be planned according to the taking into consideration that the material is a limiting factor. However, its efforts will be directed towards the maximum utilization of available resources. So you need to identify how much amount of material is available in the premises and how the optimum utilization of material can be done, then you will receive the maximization of your profitability. So thus a limiting factor is a factor by which at a given point of time the volume of output of an organization gets influenced. The key factor is the factor whose influence for the purpose of ensuring the maximum utilization of resources to be ascertained first. And the profit can be maximized by gearing up the process of the production in the light of influence by any of these key factors. As I mentioned, there are many key factors like labor, material, sales, power, capacity of the plant, actions of the government. So these are the key factors. Now here, this is the last point of the marginal costing, which is cost, volume, profit analysis. Cost, volume, profit analysis. It is called CVP analysis. CVP analysis. So here in CVP analysis, if you identify, there are three important words. One is cost. That is the part of affected on the basis of a certain amount of variable cost as well as the fixed cost. The second is profit. The profit is also affected by the cost as well as the volume. And the third is the volume, that means the amount of an output, turnover of manufacturing products as well as the volume of sales. There exists a very close relation between these three. All these three are interconnected. As a simple fact, one knows that if the volume increase, in case of the volume increase, then the cost per unit will decrease. Then the cost per unit will decrease. And in the case of that, the profit is always increase. So this is a relation between these three. Case of volume increase, automatically the cost per unit is going down because of the one by one unit is increasing, the total cost, and especially fixed cost has been distributed between the larger number of units, and that's why the CPU comes down. In case of the cost per unit is down, the profitability is automatically increased. Thus, one can conclude that there is a direct relationship between the volume and profit. There is a direct relationship between the volume and profit. Because if the volume is increased, automatically the profit is going to increase. But there exists an inverse relation between the volume and cost. They have a inverse relation, reverse relations between the volume of cost. Because if the volume is increased, the cost per unit is down. In case of a volume is decreased, the cost per unit is increased. This analysis of CVP may be applied for profit planning, cost control, evaluation of the performance, and a decision making. The CVP analysis provides useful results only when certain assumptions are made, such as fixed costs do not change. Then the profits are calculated on the variable cost only. All variables per unit remain constant. These are the assumptions. There is a single product of a constant sales mix in case of a multiple products also. Cost can be accurately divided into fixed and variable components. The analysis applies only for a short-term horizon. That means we are not supposed to calculate it for a longer duration. These are the assumptions. The analysis applies to a relevant range only. And the amount of a total cost and total revenues are lines of actions of output. So this is what all about a CVP analysis, and this CVP analysis would be important for the calculation of cost, volume, profit affected for a better management decision in future.